People look at cash and they see dead money. They see opportunity cost. They see their neighbor getting rich in the stock market while sitting there with dollars earning nothing. And that drives them crazy. I've watched this pattern repeat itself my entire life. And I am telling you right now, at 99 years old, having lived through more financial crises than most people can name, that this attitude, this obsession with being fully invested all the time, is one of the most dangerous psychological traps in investing. Let me tell you something that might surprise you. The way to get rich is to keep 10 million in your checking account in case a good deal comes along. Now, I am being somewhat facetious with that specific number, but the principle is deadly serious. Cash isn't trash. Cash is optionality. Cash is power. And most importantly, cash is what lets you act when everyone else is frozen in fear. I remember, and this must have been back in 1973, maybe early 1974, Warren and I were sitting on substantial cash reserves while the market was collapsing around us. The Nifty 50 stocks, these were the darlings of institutional America, were getting absolutely obliterated. Stocks that had traded at 50, 60 times earnings were suddenly at 15 times earnings, and they kept falling. It was brutal. You know what everyone was telling us. They said we were fools. They said we were missing the recovery. They said cash was trash and we needed to be fully invested. And we just sat there, we waited. Because we understood something that most people never figure out. It is waiting that helps you as an investor. And most people just can't stand to wait. They need to do something. They need to feel active, feel useful, feel like they're reparticipating. But you know what? Sitting on your rear end is often the highest form of action in investing. Let me explain the psychology of this, because this is really where people get confused. When you are fully invested and a market crash hits, you are helpless. You can do anything. You watch your portfolio get cut in half and you have no ammunition. You can buy the bargains that start appearing because you are already fully committed. Worse than that, you might have to sell something just to raise cash. And when you are forced to sell during a panic, you are selling at exactly the wrong time to exactly the wrong people. But when you got cash, when you got liquidity, the whole psychology flips. Now you are not scared, you are excited. Every down day is a gift. Every panic seller is your friend. You can move while everyone else is paralyzed. That is what cash does. It changes your entire psychological relationship with market volatility. Ivy said before that if you are not willing to react with equanimity to a market price, decline of 50% 2 or 3 times a century, you are not fit to be a common shareholder. You deserve the mediocre result you are going to get. But you know what? Having cash makes it a whole lot easier to have that equanimity. When you got dry powder, a 50% decline does feel like a disaster. It feels like a sale at your favorite store. Let me tell you about 2008 and 2009, because that was a perfect demonstration of this principle in action. When Lehman Brothers failed in September 2008, the entire financial system seized up. Credit markets froze. Stock prices cratered. The S&P 500 fell from around 1,400 in the summer to under 700 by March 2009. That is a 50% decline, maybe more. You know what was happening during that time? Companies were desperate for cash. Good companies with real businesses and real earnings power. They couldn't raise capital at any reasonable price. Banks weren't lending. The commercial paper market had shut down. It was genuine panic. And you know what Berkshire did? We invested $20 billion. We did deals with General Electric. We did deals with Goldman Sachs. We bought into companies that were temporarily impaired but fundamentally sound. And we did those deals on terms that were extraordinarily favorable to us because we had something nobody else had, cash and the willingness to deploy it. Now here is the thing. We could only do that because we been holding cash. If we been fully invested in 2007, we have been forced sellers in 2008. We have been part of the problem instead of part of the solution. But because we always run Berkshire conservatively, because we borrow less and on more favorable terms, because we happier with less leverage, we had the ammunition to act. People say we could have made more money if we used more leverage before 2008. Maybe that is true. But you know what? Missing out on some opportunity never bothers us. What would bother us is being forced to sell something we want to own because we could meet our obligations. That is the difference between permanent loss and temporary inconvenience. You know what my idea of shooting a fish in a barrel is? Draining the barrel first. That is what holding cash before a crash does. It drains the barrel. When everyone else is scrambling, when everyone else is desperate, when everyone else is forced to sell at any price. That is when having cash turns from a drag on returns into the most powerful tool in your arsenal. Let me tell you about the psychology of forced selling, because this is critical to understanding why cash matters. When you are leveraged, when you are fully invested, when you don't have reserves, you lose your independence. You become subject to the whims of the market. If the market demands you raise cash, you have to raise cash. You have no choice. And that means you are selling when prices are lowest and buyers are scarcest. But when you got cash, you are independent. You can wait, you can be selective. You can move only when you have the advantage. You have to understand the odds and have the discipline to bet only when the odds are in your favor. Cash is what gives you that discipline. Because when you got cash, you are not desperate. And not being desperate is a tremendous competitive advantage. I remember back in the early 1930s, and I am talking about stories I heard from my father and other people who lived through it. The Depression was a catastrophe for most people. But there were a few people who had liquidity, who had cash, who made fortunes during that period. They could buy stocks that yielded dividends twice as high as the interest rates on bonds. They could buy businesses for 10 cents on the dollar. They could hire talented people cheaply. They could expand while their competitors were retrenching. We profited from others. Demoralization from the previous generation. That is how opportunity works. It comes from dislocation, from panic, from other people's mistakes. But you can only take advantage of that opportunity if you have the resources to act. And the primary resource you need is cash. Now, I want to address something that I hear all the time. People say, Charlie, holding cash is expensive. I am losing out on returns. I could be compounding that money in stocks. And that is true. In a normal environment, cash earns less than stocks over time. But investing isn't about maximizing returns in normal environments. It is about surviving abnormal environments and being positioned to profit from them. Think about it this way. Suppose you are fully invested in earning, let's say 10% a year for 9 years. That is great, your money more than doubles. But then in the 10th year, there is a crash and you are down 50%. What is your compound annual return over that decade? It is barely positive. All that performance in the good years got wiped out because you couldn't survive the bad year. Now suppose you hold 20% in cash, and that cash is earning, let's say 2%. Your returns in the good years are a bit lower, maybe 8% instead of 10. But when the crash comes, you can deploy that cash at the bottom. You can buy great businesses at 50 cents on the dollar. Suddenly that 20% cash position turns into a 40% equity position without you having to sell anything. And those new investments compound from crisis level prices. The mathematics are overwhelmingly in your favor. This is what most people miss. They think about cash as a drag on returns, but cash is actually an option on future opportunities. And in investing, the value of optionality is enormous. You can raise money when you need it. You can sell assets when you need to. But if you got cash, you can do whatever you want whenever you want. That flexibility, that optionality is worth far more than the couple percentage points of return you are giving up in normal times. Let me tell you about our philosophy at Berkshire, because I think this illustrates the point. We operate with what some people call excess conservatism. We don't stretch for return. We don't use our balance sheet efficiently in the traditional finance professor sense. We keep large cash reserves even when it looks foolish to do so. And you know why? Because we're playing a different game than most people. We're not trying to maximize short-term returns. We're trying to survive and compound for decades. And to do that, you need to be able to act when opportunities arise. You need to be able to wade in when things are really horrible, and no one else will. Ivy said before that we have a history when things are really horrible of wading in when no one else will. That is not courage. That is preparation. We can wade in because we have the cash to do it. We don't have to ask anyone's permission. We don't have to sell anything we don't want to sell. We just act. That is the power of liquidity, looking ahead. And I am thinking about the kinds of markets we might see in 2025 or 2026. I think this lesson becomes even more important. The markets today are valued at levels that historically have preceded significant corrections. We've got speculation in areas that remind me very much of past bubbles. We've got people borrowing money to buy stocks. We've got leverage throughout the system. Does that mean a crash is coming tomorrow? I have no idea. I don't make money predicting accurately. Warren and I just tend to get into good businesses and stay there. But here is what I know. Crashes happen. They re-part of the system. It is in the nature of stock markets that they go down. And when they do go down, the people with cash will have opportunities that they remember for the rest of their lives. The people without cash will have horror stories about how much they lost. You know what the big money is? It is not in the buying or the selling. It is in the waiting. That is the hardest lesson for people to learn. They think investing is about activity. It is not. It is about patience and being ready to pounce when the opportunity presents itself. Because in this world, opportunities don't last very long. Successful investing requires this crazy combination of gumption and patience, and then being ready to pounce when the opportunity presents itself. The cash is what gives you the gumption. When you know you've got ammunition, you are not scared of what might happen. You are actually kind of hoping for it. Not in a malicious way, but in a realistic way. You understand that market dislocations create wealth transfer opportunities, and you want to be on the receiving end of that transfer. Let me tell you about a mindset that I think is crucial here. Most people think about bear markets as something to avoid, something to fear, something to protect against. That is the wrong frame. Bear markets are transfer mechanisms. They transfer wealth from the impatient to the patient, from the leveraged to the unleveraged, from the scared to the prepared. If you've got cash, you love bear markets. They when you make your real money, not in the sense that you time the bottom perfectly. Nobody can do that consistently, but in the sense that you get to buy quality assets at prices that never made sense before, and probably won't make sense again for a long time. I remember Warren telling me once, and this was probably back in the 1970s, that you should remember that good ideas are rare when the odds are greatly in your favor. Bet heavily. Cash is what allows you to bet heavily when those rare opportunities arrive. If you are always fully invested, you can bet heavily on anything new. You are already committed. Now, I want to talk about something that I think is really important, especially for people who are accumulating wealth rather than managing large pools of capital. The percentage of cash you should hold depends on what opportunities are available and what you think might be coming. If valuations are reasonable and you are seeing good opportunities, there is nothing wrong with being mostly invested. But if valuations are stretched, if speculation is rampant, if you are having trouble finding things that make sense, that is when you should be building cash. Not because you are predicting a crash, but because you are recognizing that the opportunity cost of being invested has gone up relative to the option value of having dry powder. You don't need to time it perfectly. You just need to be generally right. If you are building cash when things are expensive and deploying it when things are cheap, you do fine. The people who get in trouble are the ones who are always 100% invested regardless of valuations, or the ones who try to time things perfectly and end up paralyzed. Let me give you some practical guidance here, because I think this is where theory meets reality. If you are a normal person, not running a $100 billion company like Berkshire, I'd say you probably want to keep somewhere between 10 and 30% in cash or short-term bonds, depending on market conditions. When markets are at normal valuations, maybe 10 or 15%. When markets are expensive, maybe 25 or 30%. And when markets crash and you are deploying that cash, you don't deploy it all at once. You buy in stages, you leave yourself some ammunition in case things get even cheaper. The key is understanding that cash isn't something you hold because you are scared. It is something you hold because you are scared. It is something you hold because you are prepared. It is ammunition. It is optionality. It is power. And in a crisis, power is what matters. You know what I've noticed over all these years? The people who make real money, lasting money, generational wealth, they not the ones who are always swinging. They the ones who wait for the fat pitch. And you can wait for the fat pitch if you've already committed all your capital to mediocre pitches. I think about it like this. Every investor has a punch card with 20 slots. And every time you make an investment, you punch a slot. When you punched all 20 slots, you are done for life. That is the punch card mentality. It forces you to think about opportunity cost. It forces you to wait for the really good ideas. And having cash is what allows you to wait, because you know that when the really good idea comes along, you have the resources to take full advantage of it. Now, let me address something else that I think is critical, especially thinking about the environment we might see in the next few years. Leverage is the enemy of patient capital allocation. When you are leveraged, you can afford to be patient. You have to generate returns to service the debt. You have to avoid drawdowns because they get magnified. You are playing a completely different game. We've always been much more conservative at Berkshire. We borrow less on more favorable terms. We're happier with less leverage. You could argue that we've been wrong and that it has cost us a fortune. But that doesn't bother us. Missing out on some opportunity never bothers us. What is wrong with someone getting a little richer than you? It is crazy to worry about this. The reason we don't worry about it is because we understand the downside of leverage. When you are leveraged and things go wrong, you don't just lose money. You lose control, you lose independence. You become subject to forces you can't control. And that is unacceptable to us. I want you to think about the worst case scenario. Not the base case, not the likely case, but the worst case. If you are fully invested with no cash reserves and the market drops 50%, what happens? You watch your wealth get cut in half. That is painful. But if you don't panic, you can recover. But if you are leveraged and the market drops 50%, you might get wiped out completely. You might get margin called and forced to sell at the absolute bottom. Your mistake becomes permanent. That is the difference between playing to win and playing not to lose. We play not to lose first, and then we try to win. Here is something else I've learned over the decades. The best opportunities come when everyone else is scared. Not just nervous, but genuinely terrified. And here is the thing about fear. It makes people stupid. Smart people, sophisticated people, experienced people, they all make terrible decisions when they scared. But if you got cash, if you prepared, if you are not leveraged, you are not scared. You are calm. You can think clearly while everyone else is panicking. That is an enormous advantage, and it is entirely a function of having liquidity. I think about Warren and me sitting in our offices during 2008 and 2009. And we weren't scared, we were excited. We knew it was a once-in-a-generation opportunity to make investments that would compound beautifully for decades. And we could be excited because we had the cash to act. If we'd been fully invested or worse, leveraged, we'd have been scared too now. I am not saying you should sit on huge piles of cash waiting for the next Great Depression. That would be foolish. But I am saying you should always have ammunition, always have dry powder, always be in a position where market dislocations are opportunities rather than threats. And here's the beautiful thing about this philosophy. It makes investing less stressful. When you know you've got cash, when you know you are prepared, you stop worrying about market volatility. You stop checking prices every day. You stop panicking when things go down. Because you know that if things really go down, if we really get a crisis, you'll be able to take advantage of it. That psychological peace, that ability to sleep at night, that is worth a lot. It is worth more than the extra couple percentage points you might make by being fully invested. Because stress, fear, panic, these things lead to mistakes. And mistakes in investing, they compound negatively just like good investments compound positively. Let me tell you what I really think about all of this. The smartest investors I've known, and I've known quite a few over the decades, they all share one characteristic: they re-prepared, they re-ready, they got ammunition, and they re-patient enough to wait for the right opportunity to deploy it. The dumb ones, the ones who blow up, the ones who have spectacular success followed by catastrophic failure, they all the same too. They always fully invested. They use leverage. They can sit still. They need action. And when the inevitable crisis comes, they have no options. They trapped. So if I were to give you one piece of advice, one lesson from 99 years of watching markets and human behavior, it would be this: always hold cash before the crash hits. Not because you are predicting the crash, not because you are scared, but because you are prepared. Because you understand that liquidity equals opportunity. Because you know that the way to make real money is by being fully invested all the time, but by being positioned to act when others can. And you know what? When you get this right, when you built up cash and then deployed it during a crisis, the feeling of accomplishment, the satisfaction of having done it right, that is almost as good as the money itself. Almost, because at the end of the day, investing isn't just about making money. It is about doing it right. It is about being rational when others are irrational. It is about being patient when others are impatient. It is about being prepared when others are complacent. And cash, boring, unsexy, low, returning cash is the tool that makes all of that possible. So don't listen to the people who tell you cash is trash. Don't worry about missing out on some rally. Focus on being prepared for the inevitable crisis, because the crisis will come. It always does. And when it does, you want to be the one with ammunition, not the one scrambling for it.